Biweekly payments or extra principal, you're about to pick the slower one, and it could cost you around $1,746 in interest and 2 extra months of payments on the modest loan, more on a big one. Here's the part nobody tells you. These two strategies are almost the exact same move, wearing different outfits. And the version most people sign up for, the one a company charges you a few $100s to set up, is the one that pays off a little slower. You are being sold the worst product. So you've got a mortgage, and somewhere along the way, someone told you there's a trick to killing it years early. Maybe your bank pitched a bi-weekly program. Maybe a coworker swears by throwing extra cash at the principal. The decision in front of you is which lever to actually pull, because getting it wrong doesn't just cost you a few dollars. On a 30-year loan, the difference between doing this well and doing this badly is measured in years of your life still owing a bank and tens of thousands in interest. Everything about this choice turns on one variable. Almost everyone gets wrong. It's not how often you pay. It's how much extra principal you put in per year, and how fast that extra money actually touches your balance. Nail that one idea, and the rest of this decision becomes simple. Let's do the math the marketing hides. 52 weeks in a year. A bi-weekly plan charges half your monthly payment every 2 weeks. Half a payment, 26 times, that's 13 full payments. But a normal monthly schedule is only 12 payments a year, so bi-weekly quietly slips in one extra full payment every single year, and that 13th payment is the entire engine. Now watch the other method. Take your monthly payment, divide it by 12, and add that sliver to every check. 12 payments, each 1/12 bigger, add up to exactly one extra payment a year. Same 13th payment, same engine. 2 roads, identical destination. The every 2 weeks rhythm that makes bi-weekly sound sophisticated contributes almost nothing. The extra 8.3% of principal you feed the loan each year is doing all the work. Now put them side by side and race them. Here's a clean example from the mortgage professor. A $100,000 loan at 8% over 30 years. Bi-weekly pays it off in 277 months, saving $44,160. The do-it-yourself version, adding $61.15 to each payment, finishes in 275 months, saving $45,906. The homemade method wins 2 months sooner and $1,746 more in your pocket. The free method you set up yourself beats the paid program you sign up for. Why? Timing. When you add extra principal to every monthly payment, that money hits your balance immediately, month 1, and starts shrinking the interest right away. The bi-weekly extra dollars don't get their full effect until they accumulate into that 13th payment later in the year. And that timing gap can get a lot worse depending on who holds your loan. Here's what actually happens to your half payment. You send it in every 2 weeks, feeling productive watching your money leave. But many servicers don't apply that half payment to anything. They park it in a holding account until the second half shows up, then apply one full payment. Which means for weeks at a time, your extra cadence buys you 0 principal reduction. You get the once-a-year effect and nothing more, while someone adding 1/12 monthly is chipping the balance down on day 1 every month. That's the timing paradox. Bi-weekly makes you feel faster while potentially being slower. Before you ever start, get it in writing that partial payments are applied immediately, not held. If they're held, the every 2 weeks magic evaporates. Let's zoom out from the tiny loan, because the real numbers get your attention. On a $300,000 loan at 7%, one extra payment a year saves roughly $98,545 and clears it 6 years early. A $200,000 loan at 6.5% saves $58,747, also 6 years sooner. A $320,000 loan finishes about 4 years ahead. The pattern is consistent. That 13th payment typically drags a 30-year term down to somewhere around 24 to 26 years. A word on these figures, they come from lender calculators like Chase, Rocket, and the Mortgage Professor, so treat them as illustrative, not promises. They scale with your rate and your balance, and they assume you never stop. But here's the encouraging part. You don't need a giant loan or a giant payment. Around $100 a month extra can still shave several years off. This is scalable, not all or nothing. Whatever you can add, flagged to principal, compounds in your favor. So if the do-it-yourself version is faster and free, why do paid biweekly programs exist? Because confusion is profitable. Third-party setup fees run roughly $200 to $400, plus a few dollars per payment, quietly skimming the savings you came for. And it gets darker. One company, Nationwide Biweekly Administration, charged around 135,000 customers close to $1,000 each. The Consumer Financial Protection Bureau found the fees ate up most or all of the interest savings, and a $7.93 million penalty for deceptive marketing was left standing all the way through the courts. Read that as the whole topic in one story. A product built to sell you math you can do yourself for nothing. If a program charges a setup or per payment fee, that fee is the entire reason it exists, and it's coming out of your savings. Before you commit, one honest question: is paying the mortgage down even the best home for this money? Take an extra $250 a month and instead of the mortgage, put it in a broad stock index averaging around 10% over about 21 years. Investing could come out ahead by roughly $37,900. That's not guaranteed. It assumes returns that swing year to year, but it's real opportunity cost. The clean way to think about it: paying extra principal earns you a guaranteed risk-free return equal to your mortgage rate. If your rate is 6.5%, extra principal is like a safe 6.5% return. And beating that safely is hard. If your rate is very low, say under 4%, the math tilts toward investing the difference instead. So the threshold is simple. If your mortgage rate is higher than what you'd realistically earn after tax elsewhere, pay it down. If it's low and you'd actually invest the difference, the market probably wins over time. Here's decision framework. No matter where you are, if your goal is the fastest payoff at zero cost, add 1/12 of your monthly payment to every payment and explicitly flag it to principal. That single move slightly beats biweekly and never costs you a program fee. If you're paid every 2 weeks and you want set it and forget it, biweekly is fine, but only through a free option from your own servicer. Never a fee-charging third party. The hard rule on any program: if it charges a setup or per payment fee, walk away, because the entire math depends on paying no one. Before you start, confirm 3 things in writing. 1. Extra funds apply to principal, not next month's interest or escrow. 2. No prepayment penalty. Federal rules bar 1 on most residential loans after about 3 years. 3. Partial payments aren't held until month end. Then protect yourself first. Keep an emergency fund and capture any full 401k match before you accelerate the mortgage. Because principal you've paid in is locked up and hard to get back. And if the big numbers feel out of reach, start with $100 a month. It still works. So which pays off your mortgage faster? Extra principal added monthly, flagged to principal, and it does it for free while beating the version people pay for. Bi-weekly versus extra principal was a trick question the whole time. They're the same 13th payment. The only real mistake is paying a company to do arithmetic you just watched us do in minutes. Your one next step today: pull up your last mortgage statement, find your payment, divide it by 12, and set up that extra amount flagged to principal. That's the whole trick. Next, watch our breakdown on paying off the mortgage versus investing the difference, so your money goes exactly where it earns the most.